In March 2020, the Federal Reserve did something it had never done before. It announced it would buy an unlimited amount of assets. Unlimited. Not a number, not a ceiling. Unlimited. Within weeks, the stock market, which had just suffered its fastest crash in history, began recovering. Within months, it had hit new all-time highs. Unemployment was still at 10%. Businesses were still shuttered. People were still lining up at food banks. The market was melting up. The economy was melting down. And somehow, both things were true at the same time. That is not a coincidence. That is a system working exactly as designed. You just weren't told about the design. Since 2008, the world's major central banks have created roughly $25 trillion in new money. 25 trillion. If you laid that in $1 bills end to end, you would circle the earth more than 95,000 times. Every time that happens, every time new money enters the system, somebody gets it first. And the person who gets it first gets it before prices have adjusted, before inflation eats into its value, before anyone else even knows it exists. That first mover advantage has a name. Most people have never heard it. It is called the Cantillon Effect. And once you understand it, you will never look at monetary policy the same way again. Start with a simple image. Imagine a town. In that town, there is one bakery, one hardware store, and one farmer. Prices are stable. Everyone knows roughly what things cost. Life is predictable. Now the king decides to mint new gold coins. He does not airdrop them evenly across the town. He gives them first to his knights. The knights spend them on bread, on lumber, on grain. The demand for those things rises before the supply can catch up, so prices go up. By the time the new money trickles down to the baker, the farmer, the shopkeeper, everything they need to buy is already more expensive. They got the money last, and they got it after it was already worth less. That was 1755. Richard Cantillon, an Irish-French economist, described this mechanism in precise detail. The insight died with him. He was murdered, somewhat ironically, and his house was set on fire. But the mechanism did not die. It is operating right now, at scale. Today, the king's knights are called primary dealers. These are the 18 or so major banks, Goldman Sachs, JP Morgan, Citigroup, that are legally authorized to transact directly with the Federal Reserve. When the Fed buys bonds, it buys them from these institutions. The new money lands in their accounts first. They don't put it under a mattress. They deploy it into equities, into real estate, into private credit, into assets. Asset prices rise. The institutions that owned those assets, which is mostly wealthy individuals, pension funds, and more banks, see their balance sheets inflate. The money is brand new. The prices have not yet adjusted. For a brief window, the first recipients are spending money that is worth more than it will be by the time it reaches you. Here is where it gets specific. Between 2009 and 2023, the S&P 500 rose roughly 600%. The median household income in the United States rose about 40% over the same period. Inflation adjusted, real wages for the bottom half of earners have barely moved since the 1970s. Meanwhile, the combined wealth of American billionaires has increased by over $5 trillion just since 2020. $5 trillion in 4 years. Now ask yourself, is that because those people are $5 trillion more productive? Did they invent $5 trillion worth of new things? Or did their assets simply rise in price as new money flowed into the system and they owned the assets that were nearest the spigot? The Fed will tell you quantitative easing is a blunt instrument, that it was necessary to prevent financial collapse, that the alternative was worse. These are not lies, but they are incomplete truths, because the mechanism that prevents collapse also reliably, predictably enriches the people already closest to financial power. This is not a conspiracy.
It does not require a secret meeting. It is structural. It is the plumbing, and the plumbing has been running in one direction for a very long time. You may have been told that the solution to inequality is growth. A rising tide lifts all boats. Print money, stimulate the economy, everyone benefits. Here is what the data actually shows. After the 2008 financial crisis, the Federal Reserve expanded its balance sheet from roughly $900 billion to $4.5 trillion. In the decade that followed, the top 1% captured more than half of all income gains. The bottom 50% captured around 12%. The tide rose. Some boats were on dry land. In the 12 months following the March 2020 crash, the Federal Reserve injected $3 trillion into the financial system. During that same period, roughly 8 million Americans fell into poverty. Meanwhile, the Nasdaq returned 80%. These are not contradictory data points from different planets. They are the same system producing its intended outputs. New money does not appear in your wallet. It appears on bank balance sheets, and then it moves, as money always moves, toward whoever has the most of it already. There is something almost absurd about the political debates we have about redistribution, about tax rates, about who deserves what, while this quieter, more powerful redistribution operates continuously in the background, outside the legislative process, with no vote, no debate, no line item. When the Fed raises or lowers interest rates, it affects the price of every asset on Earth. When it buys bonds, it redirects trillions in purchasing power. These decisions are made by an unelected committee meeting 8 times a year, and their primary mandate is price stability and employment, not equity, not distribution, not the question of who gets to the new money first. Some economists argue this is the only system that works, that giving central banks political independence is what prevents hyperinflation, what keeps governments from printing money for pet projects, what tethers modern economies to something resembling discipline, and they are not wrong to make that argument. But here is what that argument skips over. The independence that insulates the Fed from political pressure is the same independence that insulates the Cantillon Effect from democratic accountability. The mechanism that stabilizes the system is the same mechanism that benefits the wealthy. You cannot separate one from the other. They are the same wire. And the stakes are higher now than they have ever been. Global debt has reached roughly $305 trillion. That is $305 trillion that at some point needs to be serviced or inflated away. And if it is inflated away, the question of who is positioned closest to the new money when that happens is not an academic question. It is the question. Richard Cantillon wrote about this in 1730. 300 years later, the mechanism is the same. The scale is just incomprehensible. The instruments are more sophisticated. The language is more opaque. But the basic logic, new money flows to those nearest the source before prices adjust at the expense of those farther away, has not changed. What has changed is the speed and the size and the number of people who have noticed. There is a version of this story where awareness leads somewhere, where the people who understand the mechanism use that understanding to position themselves differently, buy assets earlier, hold real things, build financial proximity to the source. Some people have done exactly that, and it has worked. But there is another version of this story, the one where the mechanism is too embedded, too structural, too intertwined with how modern economies function to be reformed without breaking the thing itself, where the price of monetary stability is permanent, self-reinforcing wealth concentration, where we have built a system that requires growth to survive, and where growth, by design, flows upward first. Nobody chose this. Nobody signed off on it. It emerged from centuries of practice, from institutional design, from the quiet logic of who holds the pipes when the water starts flowing. The question is not whether this is fair. Obviously, it is not fair. The question is what, if anything, a system this large and this old does when fairness conflicts with function. We haven't answered that yet, and the money keeps printing.